Welcome to Your Guide in America. In today's video, we're going to walk through a complete step-by-step guide on how to buy your very first rental property in the United States in 2025. For many people, real estate is one of the most reliable ways to build wealth, create passive income, and achieve financial freedom. But let's be honest. It can also feel confusing and intimidating, especially if you're starting from zero. That's why this guide is designed to simplify the process. Whether you are a beginner or already know a little about real estate, by the end of this video, you'll understand exactly what to do and, just as importantly, what to avoid when buying your first rental property. So, take a deep breath, get comfortable, and let's get started. Step 0. Preparing financially. Before you even start looking at properties, you need to prepare your finances. The first major requirement is the down payment. In 2025, most lenders require between 20 and 25% down for investment properties. That means if you want to buy a property worth $200,000, you should expect to have $40,000 to $50,000 in cash ready. This is very different from buying a primary home, where you might only need 3 to 5% down. Banks view investment properties as higher risk, so they raise the requirements. On top of that, remember closing costs. These usually run about 1 to 2% of the purchase price. On a $200,000 property, that's another $2,000 to $4,000. And don't forget about reserves. A smart investor always sets aside 3 to 6 months of expenses for emergencies. Imagine a roof leak or a tenant leaving suddenly. You'll thank yourself for being prepared. Finally, be realistic about mortgage rates. In 2025, they're averaging 6 to 7%, higher than what buyers saw just a few years ago. Always plan based on today's market, not yesterday's. Step 1. Building your credit score. Your credit score is the gatekeeper for your loan. Ideally, aim for a score above 700, with the best rates going to those above 740. Even a difference of 50 points could save or cost you thousands over the life of a loan. Here are quick tips. Pay bills on time, every time. Keep balances below 30% of your credit limit. Avoid applying for too many new accounts at once. Check your credit report for errors and fix them. If your score isn't where you want it to be, don't panic. 6 months of consistent payments and smart management can make a big difference. Think of your credit score as your financial reputation. The better it looks, the more trust lenders will place in you. Step 2. Organizing your documents. Once your finances are on track, get your paperwork in order. Lenders will ask for tax returns from the last 2 years, recent bank statements, and proof of income. If you're self-employed, you'll need business income and expense records as well. Here's a common mistake. Self-employed people often deduct as many expenses as possible to lower taxes. That looks good in April, but it reduces your reported income, and banks use that number to decide how much you can borrow. Being organized not only speeds up the approval process, but also shows lenders that you're serious and reliable. Step 3. Getting pre-approved. Before you go shopping, get pre-approved for a mortgage. Pre-approval means the lender has reviewed your finances and given you a letter stating how much they're willing to lend. This does 2 things. First, it tells you your budget so you don't waste time looking at homes you can't afford. 2, it makes sellers take you seriously. In a competitive market, a pre-approval letter can be the difference between winning and losing a deal. Think of pre-approval as your entry ticket into the real estate market. Step 4. Finding the right property. Now comes the exciting part, searching for your property. For beginners, the best options are usually single-family homes or small multifamily properties like duplexes and triplexes. They're easier to finance, easier to manage, and less risky than big apartment complexes. Condos might look appealing, but be careful. HOA fees can eat into your profits, and some associations restrict rentals. When choosing an area, focus on what tenants want, not your personal taste. Look at rental demand in the neighborhood, local crime rates and school ratings, property taxes, which vary widely by state, nearby job opportunities and population growth. For example, a property near a growing university or a new factory may attract steady tenants for years. Step 6. Calculating cash flow. This is the golden rule. The property must cash flow. Here's the formula. Rental income minus mortgage plus taxes plus insurance plus maintenance and vacancy reserve equals cash flow. Example, rent is $1,500. Mortgage is $1,000. Taxes and insurance is $200. Maintenance and vacancy reserve is $150. Net cash flow, $150 per month. It may not sound huge, but remember, you're also building equity as tenants pay down the mortgage. The danger is negative cash flow, where expenses are higher than rent. That's how investors lose money. Aim for at least $100 to $200 positive cash flow per unit. Step 7. Choosing light fixer-uppers. One smart beginner strategy is buying a property that needs light cosmetic upgrades. Fresh paint, new flooring, or updated kitchen cabinets can be inexpensive but dramatically increase the rent you can charge. For example, spending $5,000 on upgrades could raise your rent by $150 a month, adding $1,800 per year in income. That's a strong return. Avoid properties with major issues like structural damage or old wiring. Leave those for experienced investors. Step 8. Making offers and negotiating. When you find a property, stay calm. Don't fall in love with it. Real estate is a numbers game. If the math works, make an offer. If it doesn't, move on. Compare similar homes, called comps, to make sure you're paying a fair price. Working with an agent who understands investment properties can save you thousands in negotiations. Step 9. The importance of inspections. Before closing, always hire a professional inspector. An inspection can reveal hidden problems like plumbing leaks, roof damage, or faulty electrical systems. Think about it. A $300 inspection could save you from a $5,000 repair bill. If issues are found, you can often negotiate a lower price or request the seller fix them. Skipping this step is one of the costliest mistakes beginners make. Step 10. Closing costs. Closing day makes the property officially yours, but it comes with extra costs. Expect 1 to 2% of the purchase price in fees, including lender charges, title insurance, and legal recording. Many new buyers overlook these expenses, so be sure to budget for them from the start. Step 11. Renovating and renting. After closing, it's time to prepare the property for tenants. Choose durable, low-maintenance materials like laminate flooring and neutral paint. Take professional photos for your listing. Good photos attract more renters and can even justify higher rent. Advertise on popular websites like Zillow, Apartments.com, and Facebook Marketplace. When tenants apply, screen them carefully. Check credit, verify income, and call previous landlords. A reliable tenant can save you years of stress. A bad one can cost thousands in damages. Step 11. Scaling over time. Once you've successfully managed your first rental property, don't stop there. Even if you buy just one property every 2 years, in 10 years you could own 5 rentals. If each generates $200 in monthly cash flow, that's $1,000 per month in passive income, plus appreciation and mortgage paydown. Real estate is a marathon, not a sprint. Small, steady steps create long-term wealth. Biggest mistake to avoid. The number one mistake beginners make is underestimating expenses. They assume rent will always cover everything, but forget about repairs and vacancies. Imagine your tenant moves out and it takes 2 months to find a new one. Can you handle the mortgage in the meantime? Always plan conservatively. It's better to be pleasantly surprised by extra profit than stressed by unexpected bills. Conclusion. Buying your first rental property in the United States can feel overwhelming, but it doesn't have to be. By preparing your finances, improving your credit, analyzing cash flow, and carefully selecting the right property, you'll be on the path to financial success. Remember, this is not a get-rich-quick plan. Real estate rewards patience, consistency, and smart decisions. If you follow these steps, even one property can be the start of your journey toward financial freedom. Thank you for watching Your Guide in America. If this video was helpful, please like, subscribe, and share it with anyone interested in U.S. real estate.